All right, ladies and gentlemen, welcome back once again. This is lesson 4 of our beginner trading course. Okay, so in this lesson, I'm going to be talking about the common trading terminologies. Okay, and I'll talk about long and short. I'll talk about leverage and margin. I'll also talk about a pip. I'll talk about bid and ask. Then lastly, I'll talk about the spread. Okay. All right. So let's begin. So what is long and short? Okay. Before I go ahead and explain what long and short is, um, this in trading, there's what we call bulls. Okay. Bulls. Okay. And what bulls means? Bulls. These are actually buyers. Okay. Buyers in the market. Okay. So if the bulls are in control, okay, that means it is a bullish market. In other words, the market is buying. Okay. And another term I want you to familiar yourself is bears. Okay. So if the bears are in control, that means the price is going down. In other words, bears are sellers. So that market will be bearish when it's going down and bullish when it's going up. Okay. All right. So take note of that. All right. So what is long and short? Okay. Simply put it as your trade direction. Okay. So long means you will profit if the price goes up. Okay. Let's say a trader said, I'm long the euro card. Okay. That means they will profit when the price goes up. Okay. And if they say I'm short, let's say the USD JPY, okay, that means they actually want the price to sell and they will profit the price goes down. Okay. All right. So next, moving on, what is leverage and margin? Okay. So leverage simply means how much larger you can trade relative to your account. Okay. I've had so many people say, this is the money your broker lends you, or this is the money your broker borrows you. No, I don't see that making sense, because your broker is not actually lending you any money. Okay. What this simply means, okay, let's say for an account of $100, okay, and your broker offers you a 1 to 50 leverage, okay, your broker will allow you to hold a trade or a position worth $5,000. Okay, so they're not actually lending you the money. Okay, they're providing you means, okay, for you to be able to hold a trade worth $5,000 with just $100. Okay, so how you compute that the maximum position you can hold, you just take the leverage that your broker offers you, which is 50 times 100. Okay, and you're able to get 5,000. All right. So another example is, let's say for an account size of $2,000, okay, and your broker offers you a leverage of 1 to 100. Okay, with that $2,000, okay, your broker will allow you to hold a trade of up to $200,000. Okay, now this is where I want you to pay attention. Okay, as much as the leverage can allow you, okay, with your small account, okay, to hold a bigger position, okay, let's say for a $2,000 account, you're able to hold a position worth $200,000. Okay, if the price moves in the opposite direction, okay, just by a small movement, okay, there are chances that you will blow your account. Okay, so you need to take note of that, because just imagine your small account, like $2,000, just holding a position of 200,000. Okay, just a small movement against you, you will lose that account or blow the account. Okay. All right, so let's move on to margin. Okay, what margin is actually related to leverage. Okay, and this is how it's calculated. Okay, take 100 then divide it by your leverage. Okay, then you will get your margin. Okay, and it's the reason why you divide it by 100 because it's always calculated in percentages. Okay, so as you can see right there, for example, if a broker provides you a leverage of 1 to 50, okay, you take 100 divide by 50, and that will be a margin of 2%. Okay, so going by this first example we talked about, okay, for you to be able to hold a trade or a position worth $5,000, okay, all right, your broker will um, um, will make sure or will require you, right, to deposit in your account at least $100. Okay, that's what it means. Okay, and as you can see right there, just explain that for you to hold a $5,000 account, okay, you must deposit in your account at least $100, which is 2%. That's what margin is. Okay, all right, so let's move on. So what is a pip? Okay, so a pip is just a point in percentage. Okay, or it's a unit of measurement. Okay, all right, so in most currency pairs, a pip is the fourth decimal place. Okay, in most currency pairs, it's the fourth decimal place. So we have an example. Let's say for the Euro USD pair. Okay, if this um, if this pair moves from uh, 1.0012 to let's say it moves from 1.0012 to 1.0015. Okay, and as you can see right there, this price jumped from this point to this point. Okay, so in other words, the price, this was the price boat. Okay, so the price was going up because it moved from 2, as you can see, from the fourth decimal place right there, 2 to 5. So the price went up. Okay, so how do we measure that movement? Okay, we measure it in pips. Okay, and if you take 5 minus 2, okay, it will give you 3 pips. Okay, simply put a pip as a unit of measurement. Let me give you another example. Let's say you drove your car from point A, all right, to point B. All right, so the distance you drove your car, okay, could be measured in kilometers, okay, or miles or whatever. Okay, that's just the unit of measurement when it comes to distance. Okay, the same thing applies here. When price moves from point A to point B, we measure that movement in terms of pips. Okay, and in this case there were 3 pips. Okay, all right, so another thing to note is for JPY pairs, okay, this is different. For JPY pairs, the pip will be the second decimal place. Okay, and an example of that is let's say you were trading the USD JPY and it moved from 130.04, all right, to 130.09. Right, if you take the difference from the fourth decimal place, it will give you 5. Okay, those will be 5 pips. Okay, all right, so another thing I want you to know is there's what we call a pipet. Okay, and a pipet is smaller than a pip. Okay, but most brokers will provide you the measurement up to a pip. Okay, but just for you to know, there's what we call a pipet and it's smaller than a pip. And what this means, let's say for this example, okay, for the Euro USD, okay, let's say the price was at 1.0012, Okay, so this right here, like we talked about, the fourth decimal place, this will be our pip. Okay, but let's say there was another value right here and it said 6. Okay, so this right here will be our pipet. Okay, if the price said 1.0012, the 2 will be the pip, then the 6 will be the pipet. Okay, same thing applies to the USD pairs. Okay, if the price said 130.04, this will be the pip. Okay, then let's say it said 3 right here. Okay, to the third decimal place. Okay, for the JPY pairs. Okay, then this will be our pipet. Okay, you understood that? All right, so let's move on. So what is a bid and ask? Okay, so bid simply means the price you sell at. Okay, and ask simply means the price you buy at. Okay, so in forex trading you will be offered two prices. Okay, you will be offered the bid price and the ask price. The bid price, the price you sell at; the ask price, the price you buy at. Okay, so for an example, let's say for JBP USD pair. Okay, if the ask price is 1.0024, okay, this will be the ask price. So this will be the price you buy at. Then the bid price is 1.0018, okay, so that means this will be the price you sell at. Okay, and the difference between this is 6 pips, but I'll talk about this in the next slide because this is what they call the spread. Okay, so you can ask yourself, is why is it when I want to buy, okay, I buy this pair, let's say for example JBP USD, I'm buying it at 1.0024, and when I want to sell, okay, I'm selling it at 1.0018. Okay, where did the 6 pips go? Okay, now this is how your brokers make money, because remember, it's a business and they also have to make a living. Okay, this is how they make money. So your broker, remember, or market makers give you access to the market. Okay, because they're providing you that service. Okay, that's your entry to the market. Okay, so for them to provide you that service, they also have to make some money off it. Okay, all right, so what this means, if the difference is 6 pips, okay, I'll talk about lot size later, but just stick with me. And let's say you open a trade of 0.1. Okay, this was your lot size that you're using. That means if you open this trade, let's say you bought this trade, okay, you will begin the trade in a -6. Okay, -6 pips. Okay, or -$6. Okay, trust me, you will have to pay this amount. Okay, because this is how your brokers make money. So regardless of whether you lose the trade or win the trade, okay, this six pips, but in this case it will be $6. Okay, depending on the currency you're trading in, this money will be deducted from your account. Okay, and like I said, this is how your brokers, market makers make money, because they're also providing a service to you for you to be able to access the market. Okay, all right, so a fact I want you to understand is the bid price is always lower than the ask. Okay, then the ask price is always higher than the bid price. Okay, that's the fact. Okay, so you can either understand one of these, because it's just the reverse. Okay, it's just the reverse. Bid is always lower than the ask, so which means, in other words, the ask is always higher than the bid. Okay, all right, so let's move on to the spread. Okay, so the spread is the difference between the ask price and the bid price. I talked about it in the previous slide. Okay, and what that means, let's say for an example of this pair, okay, the New Zealand dollar against the USD, against the United States dollar. Okay, if the ask price, which is the price you buy at, is 1.0059 and the bid price is 1.0052, right, that will bring the spread to 7 pips, because remember, okay, the pip is the fourth decimal place, so 9 minus 2 will give us 7. Okay, so 7 pips. So the spread in this pair right here is 7 pips. Okay, all right, so let's do a recap of what we just talked about. We talked about long and short. Okay, and what we said is this is just your trade direction. Okay, so if you're long on a pair, that means you will profit when the price goes up. If you're short on a pair, that means you will profit when the price goes down. Okay, we talked about leverage and margin, and we said they are related. But what we talked about leverage, we said it's a double-edged sword. Okay, while it can let you, with a small account, hold a bigger position in case the price goes against you. Okay, you will blow your account or lose that account. Okay, so you need to take note of that. Then we also talked about a pip, okay, which is point in percentage, okay, or the unit of measurement, price, okay, unit of measurement of price movement. Okay, we also talked about the bid and ask. We say the bid is the price you sell at, okay, and ask is the price you buy at. Okay, then we talked about the spread, which is the difference between the bid and the ask. All right, so I've come to the end of this video. I'll see you in another one. Bye.